in this case, a customer orders a product for $100 but doesn't pay for it in cash. So most of you will know that an accounts receivable account is going to be created in the end. So it actually ordered the product, so we can record it as revenue, regardless of whether or not the company received cash. So revenue is going to be reported worth $100, and assuming no tax rates, net income is going to be increased by 100. Cash flow from operations will start from 100, and retained earnings in the end will increase by 100. But let's think from the cash flow statement's perspective. In the end, how much cash did the company collect? None. So despite the fact that the customer will eventually pay, or the company will eventually collect cash in the future, at this point of time, no cash has been collected, so no cash inflows or outflows. Starting from 100, it ends at 0, so we have to make some kind of adjustment. Is it a difference from operations or investing or financing? It's a difference from operations. So a $100 adjustment is going to be made. We're going to write increase in accounts receivable. So it's an increase in assets, so a cash outflow, recorded as a cash outflow adjustment. So the cash flow statement is set. Changes in cash will be 0. And because we have an increase in accounts receivables, receivables account will increase by $100, and the balance sheet will match on each side. So revenue increased by $100. Net income is also up by $100. The income statement was fairly simple. From the cash flow statement, we had to make adjustments because net income started from 100, but we finished off at 0. So we need a negative $100 adjustment that is due to an increase in accounts receivables. Cash stays the same, but accounts receivables is up by 100, and it is balanced by the 100 increase in retained earnings. Let's say that time has passed, and in the next year, the accounts receivables has been collected by the company. So this is a complete opposite of the previous question. So what's going to happen in the income statement? Nothing. Nothing is going to happen from the income statement because revenue has been already recorded, last year. So revenue is going to be 0. EBT, net income, is going to be 0. And we're going to start from 0 in the cash flow statement. However, now from the cash flow statement's perspective, we have collected $100 worth of cash. So again, there are differences from net income to changes in cash balances, and we have to make adjustments somewhere, which in this case, we're going to write decrease in accounts receivables, and it's going to be a positive adjustment worth $100. The cash flow statement is now set. Changes in cash is going to affect year-end cash balances by 100. So we're going to have more cash at year-end, which is offset by a decrease in accounts receivables. And now the asset side matches the liabilities plus equity side. So again, there are no changes to the income statement, as revenue has been recognized upon sales last year. However, cash worth $100 has now been collected, so the differences come from a decrease in AR. Cash is up by 100, and since accounts receivables now has been collected, its balance decreases by 100, with the remaining balance now at 0.